big kia ora to Ian Miller. We're thrilled to kick off this Money Week with Ian Miller. Ian is the Director of Sales and Strategy at Simplicity KiwiSaver and has over 30 years of financial market experience in New Zealand. Corporate superannuation and institutional investment have been at the heart of his roles over the years. And Ian was part of the original team with Sam in the early days of Simplicity and is now an integral part of that team. And for those of you that don't know, Simplicity is a non-profit and 100% online KiwiSaver scheme. This means that they only charge what it costs and nothing more. And earlier this year, Simplicity was announced as one of the 6 default KiwiSaver managers, which is obviously huge validation for a social enterprise that only started less than 5 years ago. Ian also wanted me to share that along with Simplicity, his second love is his vote. And yes, Ian, we are thrilled to have you along and be part of the conversation today. Ian will be taking us through a bit of a presentation about KiwiSaver. And if you all see at the bottom of your screen, you will see a little Q&A box. So if you have questions, along the journey, pop those into the Q&A box, and later on in the session we'll be able to tackle those Q&As. We would love this to be an interactive experience, so really do feel free to put those questions in. We have the time of Ian, who is an expert in this field, so let's make the most of it and ask Ian all of our tough and challenging questions about KiwiSaver. Ian, I'm going to hand that over to you.
Oh, thank you, and good morning, everybody. I guess, firstly, it's worth just reflecting that, we don't always take just out of, half an hour to think about ourselves and to think about money. We're often thinking about work things and others. So this Money Week is such a fabulous opportunity just to sit back and just take in some information from lots of players. Certainly, listening to the lineup that Spring's got organised for the rest of the week, it sounds really exciting. But look, I'll kick off. As you can see out the window, it's a beautiful day in Auckland, and it hasn't been that for a little while. Excuse me. Fantastic. I can do everything except change the slide. First technology hitch of the day. There we go. So, Simplicity, just very brief. I've got a small introduction just explaining who we are and what we do. And then what I'd like to do is just try and dispel a few scary things, a few myths that seem to be invading our thinking about money. And at the outset, if I could just position that as we think that New Zealand is set for an economic renaissance such that it's never seen before. So if you're having children right now, this is about the best time ever to have children in this country, because they are going to grow up in a capital-rich environment. But Simplicity is all about, we're a dignity company. And what we mean by that is, to have dignity, you have to have choices. And in order to have choices, you have to have money. It's as simple as that. So we're here to try and make the average Kiwi a little bit richer so that they have a few more choices, which gives them a little more dignity. We're a really simple company. We're a not-for-profit business. We're owned by a charity, and we pass 15% of all of our funds to charity. And we have huge aspirations for that to be one of the largest charities in this country. That's going to take some time and lots of work, but we're certainly heading there. Again, very simple business. We do KiwiSaver funds, we do investment funds, and we also offer mortgages. Very simple. Kind of a new way and an old way. Out go the high fees. We're trying to do things as cheap as we can. We don't have profits or shareholder earnings. All our profits go to our members. No company cars, no shiny head offices, and we certainly don't like commissions or margins or any of those things. So how are we doing? Look, we're only new. We're a young upstart business with now growing pretty quickly, but we've got nearly 70,000 investors. which is pretty incredible for a small business starting up. But we're saving those people just over $26 million a year. That's a lot of money. And that 26 million stays in their accounts and doesn't go out buying fancy cars. We've just managed to give away $2.3 million in charity. It's around about $130,000, $140,000 a month now. So we're highly motivated by seeing those donations grow. And our funds under management, $3.6 billion. That is a $3,600 million is a lot of money that we manage on behalf of our people. And how we're doing, look, performance-wise, we're in the top, quintile of every performance category over most time periods. So we're pretty happy with that. As an investment manager, we don't actually pretend to know what the markets are going to do, and so we don't try to pretend. And I'll take you through how we invest that money as we go through this preso. Importantly, we're values driven. No nukes, no pornography, alcohol, tobacco, gambling, firearms, etc. And this is a very deliberate approach we have. Firstly, because it's what our members want, but also investing in these companies is just good business. Tobacco companies, fossil fuel companies, they're getting starved of capital. So we think that by investing sensibly in a sustainable way has added between 0.5% and 1% to returns over the last 3 or 4 years. And we think that'll continue. Also, of course, if you ask 18 to 24-year-olds if they drink, 30% of them will say no. Well, we think they're lying, of course, but there's a reduction. Last slide I wanted to show here is for any of you out there that are Simplicity members, we have this map of the world, which we call Where in the World is My Money? And you hover over it, over any country, and it will bring up every security. We have 3,000 securities in 23 countries, and you can see exactly where your money is invested. Transparency is just critical to the way that we work. And look, we've won some great awards. We've just picked up the Most Satisfied Customer Award again this year. So broadly speaking, I'll give us like an 8 out of 10 for the last 3 to 4 years. But the bulk of this presentation now is just about investing in volatile times, investing out there. Is it as bad as what it all seems? We've got markets, theoretically at the top. We've got, is inflation going to kick back in? All those boogie things. So I thought I might just try and knock them off one by one. Here's a chart. Oh, gee, I hope everyone can see this. The blue line is the US stock market, and the grey lines that are intersecting up and down, those grey lines are recessions. And a couple of observations I'd like to make out of this slide. Firstly, the blue line is actually, the trend is your friend, right? So it's going up, and it's going up. It's been going up for a long, long time. It's also had a couple of very significant downturns, but broadly speaking, it's gone up. And if we were sitting in a room, I'd probably ask you, why is that market going up? Why does it keep going up over 100 years? And the answer is probably more, it's about human endeavor. It's about businesses trying to be better, that they learn, 100 years ago, you'd carry your sack of corn to the market. And then somebody invented the cart so you could take 3 sacks. And then you get the combustion engine. Now you can take a whole truckload. We just get better at doing things. And so we build better businesses. And about this time last year, the newspapers, I remember seeing it, I think it was in Stuff or one of those, and it said, biggest crash ever. And people got scared. People pulled their money out. They were in growth funds. They pulled them back to conservative. And a lot of value and assets were destroyed during COVID, not because necessarily of the market movement, but because of people's reaction to it. And that very bottom, oh, sorry, I'm pointing. That doesn't help, does it? On the right-hand side where the little arrow is pointing to coronavirus, it was at that very dip where almost all of the switches and trades happened. So people locked in those losses. And of course, you can see how the line has moved on so much since then. But the headline was biggest crash ever. So let's have a look at that. This is a log scale. It's the only technical term I'll use today, hopefully. But during the Great Depression, the market went from about 5,000 points to about 1,000 points. Yeah, so it lost 4,000 points. Terrible. During coronavirus, we went from about 28,000 points to about 23,000 points. So we'd lost 5,000 points. 5 is bigger than 4, biggest crash ever. And it was that sort of really dangerous reporting that frightened so many people. And of course, in the Great Depression, they lost 80% of their funds, whereas in coronavirus, it was what, I don't know, 12 or 15%, nowhere near the biggest crash. So be careful of the things that we see and hear. Next one is debt. You know, how on earth are our kids ever going to pay back all this debt that the government's borrowing? This is an updated slide and it's quite cool. So red is bad and green is good, pretty much, right? And 3 years ago, New Zealand was a bright green, as was Australia. So we had less than 50% debt to GDP. Now we've doubled our debt to GDP through the course of COVID, and we're about 70% now. Don't quote me. Oh, it's recorded. You can quote me. But we've certainly increased our debt loadings. But I want to just point to, say, Japan. Look at Japan as deep red. Japan has been over 200% debt to GDP, I think, since I started in this industry 30 years ago. So, and if you've ever been to Japan, the streets are wide, the buildings are tall, the tunnels are amazing, the infrastructure is fantastic. It's a very rich country. They've also had the luxury of living in virtually a 0 to no interest rate environment over that time. And Russia, well, we just think they're lying. We don't think that's true. So we do have a large amount of debt, and our debt has increased. But let's have a look at if you think about a mortgage or debt, there's two things that really matter. One is how much do you borrow? And the second thing is, what does it cost to pay back, right? And so this chart here is a chart of the New Zealand government bond rates. So this is what the New Zealand government is paying to pay for its debt. So not that long ago, the New Zealand government was paying 6-7% for its debt. And now it's paying just over 1%. So whilst never before has New Zealand borrowed so much money, never before has it been so affordable and so cheap. The New Zealand government can afford to borrow lots more money and still have not increased their debt repayment thresholds. So we think that, and that's the other thing. Look at the trend of that interest rate. And why is that? What's going on with those interest rates? Why is that? So you've all got one of these, right? You've all got a cell phone. It's technology. Technology has a massively deflationary impact on interest rates. And I can't think of a good example. Airbnb to hoteliers, very, very hard to put your prices up. Uber to taxis, Amazon to retailers. It's extremely difficult to put your prices up. So technology continues to drive down that. Now, does that mean interest rates won't go up? No. Well, I'll answer that the same as I answer all those hard questions. I have no idea. My 4 favorite words, I have no idea. But what I can say is that technology will continue to influence and push down on the way that interest rates operate in this country. Oh, I forgot this was in there. Look, fixed and floating interest rates as a while. The little green line at the bottom, which you might not be able to see, I hope you can, that's the simplicity mortgages. We haven't been going very long, but we run floating rate mortgages because we think they're smart. Floating rate, you can pay them back whenever you like, which is fabulous for recycling. But you will see, interestingly, that the floating and fixed rates change, every now and again, they'll just come to an impact point and they'll change over, where you would expect that if your floating rate was higher than your fixed rate, you would probably expect interest rates to be stable. And we've certainly seen a long period of that. Inflation's the other big bogey out there. I love this chart because this shows this ramp up of inflation back in the day, in the 70s and 80s, where perhaps uncontrolled was one way to describe it. But since the introduction of the Reserve Bank Act in '89, you can see that the Reserve Bank, with its tools, has managed to constrain inflation within a tight band. And only a couple of times when it's gone outside that band have they pulled their levers, and inflation has either jumped back into the zone or jumped back down into zone. So we think the Reserve Bank has done an amazing job to maintain inflation generally through their target. It would take a massive shock for the inflation rate to be able to get out of control. And this inflation story that we hear in New Zealand right now, I think we're the only country in the world that's having this conversation. So we're pretty comfortable with the inflation controls that we're running. But here's the thing, KiwiSaver is changing New Zealand. So every single one of us, all putting our 3% into KiwiSaver and making sure we get our government contributions, let's hope, we've currently saved about $78 billion just between us all, Kiwis. So think about New Zealand, the history of New Zealand. You know, in the 1800s, the British came in and they bought everything, right? They just gave tidal waves of money, bought or took or stole, but basically they came in with the money. And in the Second World War, after the Second World War, the Brits were broke, they went home, and in came the Americans. Americans flooded them with money. You know, some of our parents would have been driving American cars back then. But the trouble with tidal waves of money is that they go out, and it's very, very hard for long-term infrastructure management in New Zealand because of this tidal wave. Anyway, the Americans left and the Japanese came in the 80s and bought all the mills, and now they've left, and now the Chinese money's coming in and out. So tidal waves are great until they go out, right? And they just leave carnage. But what KiwiSaver is doing is it's not a tidal wave. It's just a rising tide of assets. And that rising tide of assets, that's going to be $200 billion by the end of this decade. That's what, 8 years away, if that. So, and it's our money, and it's staying here, and it'll be reinvested here. New Zealand, if you can think about Australia, Australia started saving way before we did. They have now collectively saved $3 trillion. The Australian economy is rich, and it's not because of the iron ore. If it was iron ore or uranium, whatever they pull out of the ground, they'd have a real boom-bust economy, right? But it's not the case. Australia hasn't had a recession, or up until recently, hadn't had one for 27 years. That's about savings. And superannuation money and their version of KiwiSaver underpins virtually every development, every toll road, every building that's happening. And even I look across the skyline here in Auckland, and I can see the cranes that are there are almost all underpinned by KiwiSaver money. That's our money being reinvested in our hood. Very, very interesting. So we are moving from a capital starved to a capital rich economy, no questions. So what can you do? First thing, please, if there's not many things to take away from this presentation, but the first thing you've got to do is be absolutely focused on the fees that you pay. So the average Kiwi on the average wage, putting the minimum into KiwiSaver, right? So just the minimum average, that person will pay $46,900, $46,900 in KiwiSaver fees over their lifetime. That's more than their mobile phone charges or their power bills. I mean, that is the biggest household expense you've never heard of. Fees are really, really, really horrible things. They're very important. So watch out for your fees. And that's just not for KiwiSaver. That's for investments, that's mortgages, that's all that stuff. Be really focused on it. Sorry, you're going to get me started. Last year, KiwiSaver managers earned $500 million in fees. $500 million. That's our money, right? It's not in our accounts anymore. That's why these guys drive flash cars and have real fancy power butts. That's so outrageous. But fees, please. That's the one thing that really drives me, gets my goat going. So fees really matter. And why do they matter? Now I've got some props here, and I love these. They're supposed to be oranges. They're actually wooden from Kmart because I couldn't find any oranges. Anyway, the average balance fund, just the average diversified balance fund over time, each orange is 1%. We'll earn about 5%, give or take. They'll have good years and bad years, but let's call it 5%. So your fee is 1%. Doesn't sound much, does it? But just have a think about that. What's 1% as a proportion of 5? That's 20%. So 20% of everything you earn goes away in fees. That's starting to sound more like a tax than a fee. 20% of all your earnings. Fees really matter. And I put them in the bowl and they didn't spill. So that was good. Why is that important? Because the difference, so whilst the average fee is $46,900, our fees are about $14,000. Not many managers will say, hey, we're going to charge you 14 grand to run your KiwiSaver. But that's what it is. But that difference of $30,000 compounds up over lifetime. It's a free $60,000 just by saving fees. Really important. And 60 grand buys a lot of stuff. It might buy your ice creams for your kids or everything else, but where it really matters is putting food on the table, deciding what you're going to eat, deciding how you're going to put the heater on in winter. It's really, really important. It's about basic dignity. We all want more money. There's no question about that. Poverty sucks, right? But 60,000 for doing nothing other than worrying about your fees, that's time well spent. Don't be afraid of shares. Over time, shares, along with the I guess just the general need for us to build better businesses and to get more productive, you will be rewarded for the risk over time. And I think you guys have got Sharesies tomorrow or the next day. That's a fantastic outfit, which we really like Sharesies because it's getting people to think about. It's getting people to think about. Embarrassing. Can't turn my own phone off. There we go. It's getting people to think about different companies and how they work and accessing them. But if you put $1 into the Aussie share market 100 years ago, it's now worth 280,000. Sure, you can see on the red line, there's a few nasty dips on the way, but you're rewarded for the risk of holding it. If you put that same dollar into the bank, it's only worth $200. There is no comparison to the return differential over time. Diversification really matters. This is a cool chart. It's in years. So it's 2011 on the left-hand side, and then 12, 13, 14, 15, 16. And it's probably worth just having a look at it. At the top of the list is the best performing asset class for that year. And at the bottom of the list is the worst performing asset class for that year. And the first thing I notice is there is no pattern. You can't find a pattern in there. It is just random. And so if you say to me, Ian, what's the best performing asset class next year? I'll tell you, I have no idea. And what's the worst performing asset class next year? I still have no idea. We don't think anyone has any idea. This is a completely random set of returns. So rather than try and spend lots of investors' money employing smart people to try and do something that they really don't know, we hold a little bit of everything. So we'll hold 3,000 securities in 23 countries. And if you're a bigger company, we'll just own a little bit more of you. Very simple. And we don't worry about the investment per se. We know that we're going to hold the biggest companies in all those various economies, and that we'll win some and we'll lose some, but we'll provide a market return. The one really, I know when if you look at the bright green one on the bottom left-hand side of the screen, the commodities, you might say, oh, commodities, that's pretty sexy. I'll, jump into that. I'll have that. Sounds cool. So you go and buy some and you only lose 13%. And the next year you don't lose much. Next year you don't. And then after about the fourth year, thinking, oh, I'm sick of these commodities. I can't do it, right? I'm finally out of here after the last 22% loss. The next year, boom, top of the pile. You think, oh, maybe I was right. I'll jump back in. Next year, 2017, down again. About the only asset class that's in there that has delivered a broadly consistent top half performance has actually been New Zealand equities. And that's an odd thing, isn't it? Because it's a small bourse in a very small country in the middle of the Pacific. But the New Zealand equities have actually been a stellar outperformer. And I guess there might be a couple of reasons for that too. If we just think back to the rising tide of capital that we had in that KiwiSaver slide, KiwiSaver managers right now are probably investing something like 10 to 12 million dollars a day of new money into the New Zealand share market. So there is this underpin of capital just rolling in. So you don't need to be the smartest, the sharpest knife in the drawer to work out that we still don't know which company is going to do better than the next company, but we do know that if we can hold a little bit of everything, we're going to be just fine. Diversification is your friend. It's absolutely your friend. And don't trade markets. This is a great slide. The idea of the slide is if you put $10,000 into the US share market in 1999 and put it in the bottom drawer, you'd end up with about 5.6 return over that time. Your money would be about 30,000. But if you miss just the best 10 days, so I don't know, maybe you thought the markets were toppy or they're a bit high, I'll pull my money out while I go on holidays. Best 10 days, your return's basically zero. And then if you miss just the best 60 days, you've actually lost money. So most of the big market returns on shares come on just a few days. And if somebody there knows when the next best 10 days are, if they could give me a call later, I've got a job for you, because we don't know. Equally also, we don't know when the next 10 worst days are going to be. But don't trade markets. And the cool thing about KiwiSaver is because when you're saving every week or every fortnight or every month when you get paid, you get the best of all worlds. You just keep buying. When the markets are up, you buy a few less. When the markets are down, you buy a few more. But your 3% just keeps ticking in. It's called dollar cost averaging. It's the smartest play in the book. It's just the smartest play in the book. And keep saving. So your average Kiwi, oh no, not your average Kiwi, every Kiwi. You only live 23,660 days from the day you're born till the day you're 65. And if you, what's the maths? Divided by 7, multiplied by 2 or something like that will tell you how many weekends you get. Not enough time for the boat. That's what I can say. But if you just save that 1%, if you saved $1 a day for that time, you would have put in $23,600. And at 65, you'd have $170,000. That's quite outstanding. But if it's just 1% more, if it just went from 5% to 6%, that 1% takes it to $245,000. 1% really matters. Compounding interest is your friend. And I guess while I'm there, I might just also cover off the New Zealand government has a very significant budget for government contributions. And what the government contributions are is when you save, as long as you've saved $1,043 over the 12-month period, the government gives you just over $500. Now that's free money. Not only is it free money, it's the best free money you can get. So for KiwiSaver, you put in 3, your employer puts in 3. That's 100% on your money before you start. Sure, there's some tax in there for the employer, but still near enough. Then the government putting in another 500. Every single New Zealander over the age of 18 should have a KiwiSaver account. And if nothing, they just put $1,042 in and get that free money. The government last year budgeted something like $800 million, I think it was, for the KiwiSaver contributions and didn't spend it. Didn't spend it all because not everyone was saving enough just to meet that bare minimum threshold. But it's free money. So in summary, what would I say? I would be fiercely interested in how much you're being charged for your KiwiSaver and other funds management operations. Don't be afraid of shares. Over the long term, shares will outperform every other asset class that's available in a normal diversified fund. Something like 80% of all the assets we manage are growth assets. and just a tiny proportion of the assets we manage are conservative assets. Interest rate risk on conservative assets is probably as big as it's ever been. So we would go balance to growth as a general long-term view on maximising your money. And of course, many people use KiwiSaver for their first home deposit. We're tiny, like we're 2% market share, but we would do, I don't know, 15 first home withdrawal requests a day. And with mortgages, sorry, I'm just getting sidetracking myself now, but you average, you go and put money in the bank, and the bank will give you, say, 1% for your term deposit, right? So you come along, you want to borrow some money from the bank, and the bank says, yeah, sure, I'll lend you some money at 3%. You go, okay, that's pretty good. It's a pretty good mortgage. So the person pays their 3% back to the bank gives their depositor their 1% back and keeps 2%. It's the easiest money. I mean, that's why these guys, I can't remember how many billions of dollars they earned last year. So what we do is we go, okay, well, we have to put money in the bank as well, right? Because we're running a few $billion. And the bank will give us 1%. So we've just said, okay, what we'll do is we'll lend some money to our customers at 2%. Or it's less than that, but I can't cut my oranges in half. It's 2.8, I think, or 2.9 at the moment, floating rate. So the customer pays their 2% back to us. We get that whole 2% back to our investor. So the investor's got twice as much money as they had, and the mortgage holder is paying about 2/3 of what they otherwise would. We think they're saving about $100 a week mostly. So it's all important. Every little bit, every lever you can pull just to either make your investors a little bit more money or to save them a little bit of money. Those two things combine to be really important. But hey, I'm happy to take questions. If there's anything I've missed that's important, please yell out. If there's something you'd like to know, usually I have no idea, but I can try and answer if I can.
Awesome. Thank you so much, Ian. There's definitely a lot of gems that you've shared in the last half an hour. Thank you so much. Everyone tuning in, we would love to hear your questions. Not often are you able to sit with a KiwiSaver expert, so let's really make the most of Ian's expertise and be sure to enter your questions into the Q&A. We do have one here, Ian, from Jason. And the question is, with respect to locking in losses and moving providers, how does moving from one provider to another provide impact on your returns?
Well, thank you. That's a great question. One of the things that KiwiSaver, in its infancy and design, really needed somebody to build a statue, I think, to Michael Cullen. If you looked at the nearest neighbours, looked at Australia, and to say, how are we going to build a really good long-term KiwiSaver program? Australia, it's all very employer-centric. So if you go to work for Woolworths, you join the Woolworths super scheme, and you leave Woolworths and you go somewhere else, the BHP, and then you join the BHP scheme. And after 4 or 5 years, you might end up with 3 or 4 super schemes, right? And they get sort of lost and muddled in the middle. What was just outrageously simple and sensible was that they made KiwiSaver your account. So it's your account, and your employer puts money into your account. So if you change employers, that's fine. The new employer puts money into your account. So that's the first observation I'd make. The second observation I'd make is that there's a required 10-day maximum transfer between providers. And the other nice thing is that if you wanted to change providers, you do not have to talk to your payroll. You don't have to talk to your employer. You don't have to talk to your existing provider. You simply sign up with your new provider. Most everybody's got really cool online sign-up forms. Ours takes about 2 minutes. You need your IRD number and your driver's license, pretty much. But if you've got those 2 things, most providers will be able to accept your application online. And all that happens is that new provider establishes your account, sends a message to the through Inland Revenue, who pretty much control this, to the old provider, who has 10 days maximum to move your money. The question about being in or out of the market is a good question, well made. The assets aren't actually out of the market very long, moving from A to B, because they don't cash up your funds and hold them in cash and wait for 10 days before they send them. It's all pretty much trade +2, or if you like, we call it T +2. So that's you make the investment decision on Monday, and then by Wednesday it's complete. That's usually because it takes 2 days to get unit prices. With funds all over the world, you'll strike a price on a Monday, which you won't know till Tuesday. But I would say that the not transferring because you're worried about being out of the market, I think the migration of assets these days is really very, very prompt. So I wouldn't, in the scheme of things, I wouldn't see that would be much of an issue. But all the providers are it used to be 30 days, but the Financial Markets Authority and MB have squashed that down now to a maximum of 10. And to be fair, most of the transfers that we see happen really within a few days.
Thank you, Ian. That's great to hear the efficiencies that are about now, and how you aren't out of the market for too long. One question I have for you is, I guess, just playing a bit of a case study. So say you're in your late 20s and you're looking to purchase a home within the next 5 to 10 years. Is there a certain fund that would be better to be in, given your home ownership goals? Any advice there?
Yeah, so the first thing I'd point out is we are not, I'm not able to give personalised financial advice, so I'll be as general as I possibly can be. I think the first observation is that is that in order to build a home deposit, you need to accumulate more wealth. Mm-hmm. And you will accumulate more wealth in a fund with more equities than fixed interest. So a balanced or a growth fund, if you have that sort of 5-year plus time horizon, then certainly you'd be needing to look at that balance to growth. If 5 years was your absolute maximum, there's some really cool stuff on Sorted, and also, so I'm sorry, name escapes me. But there are some very good sites which will help you try and determine your propensity for taking risk. We're a funny group, right? We have this thing called loss aversion, and that means that we hate losing $1 more than we love making $1. And you've just got to pass the sleep test at night time. So if you're worried about your money and where it is, then I would venture to bet you that you're in the wrong fund, because it's either too volatile or it's not moving well enough for you. Financial advice is really important when it comes down to those sorts of decisions. Certainly during COVID, we had people who were looking to withdraw their KiwiSaver to fund their deposit. And some of those people were in a growth fund and they'd lost, 10% of their money. And, for those people that have been saving to buy a first house, every dollar is, you've counted every dollar. You haven't got 10% swing room in these things. Managing the risk of your portfolio, the closer it is that you're likely to withdraw it, just makes sense. So yeah, be more conservative. I think the only other sort of short-term thing that's worth just thinking about, whilst we think that all of the controls and the policy settings lead towards a lower for longer interest rate environment, if interest rates do jump up, government securities and fixed interest actually loses money. It's counterintuitive, but if the interest rates go up on this side, then bond values go down on this side, right? And if it's a long bond, it goes down further. So a lot of conservative funds have 30-40% of their money in both global and domestic bonds. And so I think the word conservative is sometimes misused. It's the way that the regulations tell us we have to call it. But if it has a lot of fixed interest in it, it does carry interest rate risk. For my money, I would rather have market risk than interest rate risk right now.
Awesome, thank you, Ian. Appreciate that, and acknowledge that it's not personalized advice, but appreciate that general answer. Another question is around earlier in the presentation, you talked about a bit about Simplicity's investments and where you're investing, and it's great to see that Simplicity is not investing in anything harmful. And for those that are interested in voting with your wallet and really putting money towards those ethical investments, at Simplicity, is there a different spectrum of ethical investments, or is it standard across the board? And any advice there for those ethical investors?
Sure thing. So most providers will have an ethical fund. Just trying to think, I mean, NZX through their Smart Shares or Super Life, I think they have one called Ethica, and that's sort of a fund that's designed to be quite specific. Some of the other KiwiSaver managers have quite specific ethical funds. I think we decided that in our build, we decided that we probably shouldn't have an ethical fund specifically, but we should actually make all of our funds meet the same test. So every one of our funds applies the same test. We also include some of the United Nations principles around slavery and some other aspects. So that way, we don't have to have a special ethical fund. In New Zealand, for example, we run a New Zealand shares fund that only invests in New Zealand shares, and we're a reasonably blue collar economy, and it's pretty hard to find things that you'd say, gosh, we can't invest in that in this country. But for our New Zealand shares fund, for example, we won't invest. There's only 3 exclusions that we take out of the top 37. We don't do Sky City because of the gambling. We don't do delegates because of the alcohol. And we don't do Genesis Energy because of the currently they're still with the Kupe gas field. So, but other than that, that's about as far as we can go in New Zealand shares. In New Zealand bonds, we only invest in governments, so we don't have any credit in there because we think you've got enough credit in your portfolios as it stands. So we hold government stock and bank, and then globally we run everything through Vanguard, and they've built international funds for us. So we were the seed investors in them, where we applied all of the screens that we want to all the portfolios. And curiously, when the default exercise was completed, the new default providers have to comply with all of these new screens of drilling and oil and a whole bunch of fossil fuel things. And nice thing for us, we didn't have to change anything because we already exclude them and more. So for us, it was business as usual in that regard. But I think people are right to vote with their conscience and their wallet, because frankly, it's the right thing to do, and we think it gives you a bit of an extra return. And so the old sin stocks used to be the place to make money, but that's just not the case anymore.
Amazing. Thank you so much, Ian. And you're making it easy for the user, for sure, not needing to make that decision about ethical investing. And I guess the default is that it all is just very ethical. So appreciate that work that you and the Simplicity team do there. I've got one more question. Audience, if there is any questions you have, please drop those in the Q&A. But last question for you, Ian, from me, is if someone is deciding what the best KiwiSaver is for them, what are a couple of the questions or a few of the questions they should be asking themselves to determine what the best provider and what the best fund is for them? So what are some of those reflection questions a person should be asking themselves?
Wow. That's a great question. So first and foremost, KiwiSaver is about accumulating wealth and getting richer. So you would want to be, one of the reflection questions would be, how are you doing? What do your returns look like? And there are some great places to look. Morningstar.com.au does a fabulous KiwiSaver report. Melville Jessup Weaver in Auckland here. There are a bunch of consulting actuaries. I'm sure they wouldn't want me calling them a bunch, but you know what I mean. And they do some good. There's some very good reports which gives you a pretty clinical Olympics medal sort of race. Who's coming first, second, and third. And so as a great example out of that, you probably see Milford Asset Management would be, 1 or 2. Fisher Funds would be 2 or 3. We're 3 or 4. So you get a sense as to who's delivering returns. So I think that's important. The second part about that would probably be, what's the online experience? Can I look at my balance? Can I look at my transactions? Can I check that my employer is actually paying this money in? And look, most everybody's pretty good. Most all the providers are pretty good. But look for a great experience, because if you're interested in your KiwiSaver, you want to be able to access it really simply on your device. I think access to information is important, because it's not a life, like you're not married to your KiwiSaver provider. You can sack them in a heartbeat and move to another one. So if your provider's not doing the right thing, or you're not happy with them, you don't have to explain to anybody. You just choose another one. Bang. So to answer the question, I'd certainly look to performance. I think performance is really important. I'd look to sustainability of performance. So there was one fund manager last year that earned like 100%, but then previously they were, up and down massively. So you'd need to, actual performance is important, sustainability of performance. And I think that, the administration and user face, so you know where your money is. And then I think there's also a very large following of people that just like to do the right thing. We have a lot of our members are passionate about the charity that we run. We plant one native tree for every member that we get. And some of the young members that we have tell us all the time, we don't make that well known enough. And to be fair, I think we're about 20,000 trees behind. We grow at about 100 new members a day, so we have to bulk them up and do them in lots of 10,000s. But it's finding a place that sort of feels like that works for you. I think we have a very simple set of funds, so we do conservative, balanced, and growth in KiwiSaver. Nice and simple. Some of the other funds, you could do Southeast Asian shares, or you can do some really sexy, offshore stuff. But if you're thinking broadly diversified, long-term balanced funds, then you're probably pretty safe with any of the major players. I mean, we'd love all the members we can get, but I think broadly speaking, it's performance. Oh, fees, of course. Gosh, what am I saying? I can't forget that. Fees are just almost the singular most important thing. That's the one thing you can control, is how much money you pay.
Nice. Awesome. Thank you, Ian. So I'm hearing fees, performance, access to your own information, really. And just really what works for you.
Actually, and a bit like, so you guys do some great workplace education. We're a big fan of workplace education. So whoever you are watching, wherever you are, talk to your employer, because there are some fantastic, both online and presumably in-person, things that the employer can do for you around just financial well-being, financial literacy. It could be real simple stuff like, hey, what's KiwiSaver and how does it work? Or it might be a bit racier than that. But employers are looking kindly on workplace education and financial wellness and all the woke sort of ways they describe it. But basically, it's giving you the opportunity to take time out and think about yourself and your money. So, I mean, I look at Spring, for example, it's fantastic facilitation. So, the more people that can go and just, you don't have to agree with everything people say, but at least it gets you thinking about it, right?
Absolutely, Ian. And I think you've just segued us in nicely into, we have 8 minutes left, the last couple of questions, because this next question is about employer. We have a question here asking, what role does the employer play when it comes to their employees being part of KiwiSaver?
Right, that's a great question. So the answer to that is going to be as much as the employer wants to do. So at the very minimum, the employer is required to make deductions from your pay and to match it with 3% contributions and to make that payment. So, and there are many employers that will say, well, that's enough, that's it. There are many employers there are some employers that actually say, this is such an important thing, we're going to give more than 3%. We'll make it 5%. And I'm always surprised when I see how many employers are doing just a little bit more. Very cool. We have some employers who have things other than KiwiSaver. They might have a life insurance program or a discounted medical insurance or something like that, and they tend to package that up into sort of a package of benefits. And one of the benefits that we're seeing added more and more is, without repeating myself, is financial education. And so, it's the lunch and learn. They put on sausage rolls and get someone to come in and talk about that, or mortgages, or whatever the topic of the month is. So employers can get quite involved. There are 21,000 employers in New Zealand that have adopted what's called a preferred provider. And all that means is that when they employ somebody, if they haven't yet chosen KiwiSaver, or it's their first job, for example, and they don't choose a provider, they automatically get defaulted into that preferred provider arrangement. Now, most of those preferred providers are banks, because when KiwiSaver was set up, of course, the banks have all the relationships with all the employers. But we have quite a few of the larger corporates have adopted us, but that's probably more for our online education than it is for anything else. So we like Spring. We have a series of learn. We have a learn taskbar on our website. You're welcome to go and have a look. It's got 4 or 5 key education programs. The most popular is KiwiSaver 101, which is pretty self-explanatory. What is KiwiSaver? The second most popular is Women and Money, because women have just a different work profile over the terms of their life, with many of them having children and coming back to work. And then the third most popular learn session that we have is a how do I buy my first home? But that's a very small sort of glimpse into what an employer can make available. And those employers that do that, I just give them 3 gold stars.
Me too. I give them 3 gold stars and a big high five. It's really cool. It's really great when you do see employers really looking out for their employees and creating a well workplace.
Absolutely, because it doesn't cost much, and sometimes the biggest cost is just the time to put aside. I agree. I think we should start ranking employers from the best to the recalcitrant.
Absolutely. And I'm going to sneak in one last question from the audience here, Ian, before we wrap things up. This question is, how easy is it to withdraw money with Simplicity when need be?
Okay, great question. So Simplicity has conservative, balanced and growth KiwiSaver funds. And then sitting right next door to it, we have identical, conservative, balanced and growth investment funds. So I'll start with the investment funds first. No, I won't. I'll start with the KiwiSaver funds first. So the KiwiSaver funds, the withdrawal provisions are governed by regulations. So you may withdraw, if you're over 65, you may withdraw to buy your first home. And that's about it. There is a hardship provision, but I can promise you, this is not just having a bad day. You have to be literally destitute. It's very, very, very hard to get a hardship approval, and that's done through the supervisor, through the public trust, for them to say, yes, we think you're eligible. Very tough. There is a medical provision also, but that again, that's you sure as hell want that to be the exception, not the rule. But once you're eligible to withdraw, withdrawals work on a trade plus 2. So if we receive a withdrawal request on a Monday, you get Monday's unit price, which is calculated on Wednesday, and it's in your account Wednesday. So that's KiwiSaver, but general investments, so our share fund, our bond fund, our conservative balanced and growth investment funds, all 2 days, just 2 business days, in and out. So unless you've set up, so the answer to the question is it's really simple, and you do your withdrawal online. You go click. We like the withdrawals to be a minimum of $1,000 because it's not a bank account, but where some people use their investment funds, and the only example I can think of is somebody I was talking with last week. They're retired, but they've got money in their investment account, and they just want to top up their pension payment. Makes sense. So they've got, I think it's $75 every fortnight coming out on a trade date Tuesday to be paid on the Thursday. So they get it the same day as their pension, and it just lifts their pension up a little bit. That's really cool. So you can set them up to be regular or just whenever you want. And the nice thing about investment funds is that there are no rules per se. It's your decision. If you want to buy a car or give it to the grandkids or do whatever you like, it's entirely up to you. Whereas KiwiSaver, the restrictions are imposed by regulation. The mechanism is still the same. It's all trade plus 2. And really, in retail land where you're talking sort of tens of thousands or maybe hundreds of thousands, there's just no capacity limit to be able to withdraw or indeed invest.
Great, thank you, Ian. By the sounds of it, it sounds really easy.
Yeah.
It sounds really easy.
Yeah,
that's awesome.
So you can never forget, right? It's your money.
Yeah, exactly.
Right, it's really important. Right? It's your money, so yeah,
nice.
You should be able to choose.
Yeah, absolutely. Hey, well, on behalf of Spring, we would just like to say a big thank you, Ian, for tuning in today. I know I've gained a lot from this presentation, as I'm sure all the guests have. And guests, I would like to say also a big thank you for tuning in. It is great that you are all prioritizing, learning more about money. A little bit of learning can go a long way when it comes to your money, and the benefits can be massive. So we will be hosting a series of Lunch and Learn webinars this week. So tune in tomorrow for an interview with Sharesies co-founder Sonia. So looking forward to that and learning more about investing. And Ian has said that he's happy to share these slides. So we will be sending out a follow-up email with these slides and all the extra goodness. And there will be also a recording of this. So yes, thank you, Ian. Thank you, attendees. It's been an awesome lunch and enjoy the rest of Money Week, team. I will stop recording.
Well done, Dana.